Welcome back to Weekly Trade Advantage. Today, we're uncovering one of the best kept secrets in options trading, deep in the money call and put buying. If you're new to options or looking for ways to improve your trading, you're in the right place. What are call and put options? A call option gives you the right to buy the stock at a certain price, known as the strike price. A put option gives you the right to sell the stock at a specific price. So, when you're buying a call, you're betting the stock price will rise. When you buy a put, you're betting it will fall. Why call and put buying is the secret weapon. Now, here's the secret that many traders overlook. When you buy a call or put option, you have the potential for high rewards with limited risk. That's the key. Unlike buying the underlying stock where you risk the entire position if the stock drops, options allow you to control the same amount of stock for a fraction of the price, with your loss capped to the premium you paid for the option. Here's why this is so powerful. Leverage, a small movement in the stock price can lead to a large percentage gain in the option price. Defined risk, no matter how much the stock moves against you, the most you can lose is the premium you paid. You don't have to worry about losing more than that. Buying calls and puts is pretty straightforward, but you need to know a few things before jumping in. Choose your stock. Pick a stock you believe will either go up or down in the near future. Look for stocks with clear trends. Pick a strike price. This is the price at which you'll either buy, for calls, or sell, for puts, the stock. Choose a price that is realistically achievable within the time frame of your trade. Expiration date. Options have an expiration date. Short-term options can give you quick profits, but they carry more risk, while longer-term options, like leaps, give you more time for the stock to move. Once you've selected your option, simply place your order to buy. So, when is the best time to buy a call or put option? A good rule of thumb is to consider the stock's movement and overall trend. Here are a few strategies. Buy a call when you expect the stock price to rise. Look for strong bullish signals, maybe a breakout above resistance or positive news driving momentum. Buy a put when you expect the stock price to fall. Look for bearish signals like a breakdown below support or negative news impacting the company. Timing is so critical when it comes to options trading. You've probably heard the saying, time is money. Well, in the world of options trading, that couldn't be more true. Let me explain why. A smart trader will only buy deep in the money options, which can often be a better choice because they have a high delta, meaning they closely track the movement of the underlying stock. This reduces the impact of time decay, theta, since a large portion of the option's value comes from intrinsic value rather than time value. As a result, deep in the money options lose value more slowly over time compared to at the money or out of the money options. This makes them a more resilient choice, especially when you expect the stock to move in your favor, as they are less sensitive to short-term price fluctuations and offer a higher probability of profitability. Example of deep in the money call option on Apple. Let's use a real-world example to illustrate the dynamics of deep in the money, ITM, options and how they behave differently from OTM options when it comes to time decay. Imagine you're trading an options contract on Apple AAPL, which is currently trading at $224. You buy a call option with a strike price of $200, and you pay a premium of $24 for this deep in the money option, or $2,400 for one contract, as each contract represents 100 shares. This Apple option has a delta of 0.94 and a theta of 0.06, expiring in 30 days. In the first week, Apple moves up to $224, no change, and your deep in the money call option is still well in the money. The value of your option increases slightly to $25, a $100 profit for one contract. Everything seems good, you're happy with the trade. However, in the next few weeks, Apple moves more slowly, and by day 20, the stock is still hovering around $224. While the stock has not changed much, your option is now only worth $23.50 due to time decay. The option's value has decreased slightly from $25 to $23.50, even though the stock price hasn't changed significantly. The option has lost $1.50 of its value during this period, but this loss is mostly due to time decay rather than the stock's movement. The theta of your option is 0.06, which means you're losing approximately $6 in premium per day due to the passage of time. As you approach the final 5 days before expiration, Apple is still at $224, and now your option is worth $23. The time decay accelerates a bit, but due to the high delta and the strong intrinsic value of the option, the loss is still relatively small. You initially paid $2,400 for the option, and even with time decay, you only lose $132, or about 5.5% of the initial premium, which is a manageable loss compared to the potentially larger losses you'd face with an out-of-the-money option. This shows how deep in the money options are more resilient to time decay, offering a safer way to trade options while still benefiting from stock price movements. In conclusion, even though Apple has not moved significantly during this period, and there's still time left before expiration, the deep in the money call option behaves differently from other options with a lower delta or less intrinsic value. Remember, in the fast-paced world of options trading, time is money, use it wisely. Thanks for watching. If you found this analysis helpful, please like, subscribe, and hit the notification bell for more weekly insights into stocks and options.